When it comes to financial markets, especially Forex, the terms supply and demand are central to understanding market dynamics. However, how these concepts are interpreted and applied can vary significantly depending on the trading approach. In this deep dive, we'll explore supply and demand from both the ICT, Inner Circle Trader, and SMC, Smart Money Concepts perspectives, unraveling the intricacies that make these methodologies effective for traders who aim to capture market moves with precision. Understanding the core concepts. At its most fundamental level, supply and demand refer to the quantities of a commodity or asset available in the market, supply, and the desire of buyers to purchase that commodity or asset, demand. In trading, these forces are reflected in the price action on charts. Supply zones. These are areas on the chart where selling pressure exceeds buying pressure. When the price reaches a supply zone, it's expected to encounter resistance, leading to potential price reversals or corrections. Demand zones. Conversely, demand zones are areas where buying pressure surpasses selling pressure. When the price reaches a demand zone, it's expected to encounter support, possibly leading to a price bounce or rally. The importance of supply and demand in market movements. Supply and demand are the driving forces behind price movements. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. Understanding where these zones are on the chart can give traders a significant edge in predicting potential reversals or continuations in price. Visualizing supply and demand on charts. Supply and demand zones are often identified by looking at areas of consolidation, where the price has moved sideways before breaking out with strong momentum. These zones can be marked on the chart and used as reference points for future trading decisions. The foundation of ICT methodology. The ICT methodology, developed by Michael Huddleston, emphasizes the importance of understanding how institutional traders, or smart money, operate within the markets. According to ICT, institutional traders leave footprints in the form of price action patterns, which can be read and interpreted by retail traders. ICT's interpretation of supply and demand zones. In the ICT methodology, supply and demand zones are seen through the lens of institutional activity. These zones represent areas where institutions have placed significant orders, leading to price imbalances. These imbalances are often followed by sharp price movements, which traders can capitalize on. Liquidity pools. ICT often refers to liquidity pools, which are areas where institutional traders target stop losses or pending orders of retail traders. Supply and demand zones often coincide with these liquidity pools, making them critical areas of interest for ICT traders. Market structure. ICT traders pay close attention to market structure when identifying supply and demand zones. A break in market structure often signals a shift in the balance of supply and demand, providing clues for potential trade setups. How ICT traders use supply and demand in their strategy. ICT traders use a combination of supply and demand zones, liquidity pools, and market structure to develop high-probability trade setups. The idea is to align their trades with institutional activity, ensuring they are on the same side as the smart money. Entry techniques. ICT traders often wait for price to return to a supply or demand zone before entering a trade. This approach allows them to capture moves with a favorable risk-to-reward ratio. Risk management. Understanding supply and demand from the ICT perspective also involves careful risk management. By placing stops outside of key supply or demand zones, ICT traders can minimize their exposure to potential losses. Chapter 3. SMC Perspective on Supply and Demand. The Evolution of Smart Money Concepts, SMC. Smart Money Concepts, SMC, build upon the foundations of supply and demand, incorporating a deeper understanding of institutional trading behavior. SMC is more focused on the concept of smart money, which refers to the big players in the market, such as banks and hedge funds. Supply and demand in the SMC framework. In SMC, supply and demand zones are viewed as areas where smart money has previously executed significant buy or sell orders. These zones represent key areas of interest where smart money may re-enter the market to continue their original trade intention. Order blocks. A key concept in SMC is the order block, which is essentially a supply or demand zone formed by a block of orders from smart money. Order blocks provide critical insight into where smart money is likely to enter or exit trades. Imbalances. SMC traders also pay attention to price imbalances, where price moves sharply in one direction, leaving a gap or imbalance on the chart. These imbalances are often revisited by price, providing opportunities for traders to enter in the direction of the original move. How SMC traders incorporate supply and demand into their strategy. SMC traders use supply and demand zones in conjunction with order blocks and price imbalances to build their trading strategies. The focus is on understanding the intentions of smart money and aligning trades with these intentions. Confirmation entries. SMC traders often wait for confirmation in the form of a price reaction at a supply or demand zone before entering a trade. This confirmation can come in the form of a candlestick pattern, a break in market structure, or other technical signals. Profit targets. Profit targets in SMC are often set at the next opposing supply or demand zone, where smart money is likely to take profits or reverse their position. Chapter 4. Comparing ICT and SMC perspectives. Both ICT and SMC place a strong emphasis on understanding institutional behavior and aligning trades with the activities of smart money. Supply and demand zones are central to both methodologies, serving as key areas of interest for potential trade entries and exits. Both ICT and SMC recognize the importance of institutional activity in driving market movements. By identifying supply and demand zones, traders can gain insight into where institutions are likely to place their orders. Use of market structure. Both approaches rely heavily on market structure to confirm the validity of supply and demand zones. A break in market structure often signals a change in the balance of supply and demand, providing clues for potential trade setups. While the core concepts of supply and demand are similar in both ICT and SMC, there are differences in how these concepts are applied in practice. Order blocks versus liquidity pools. In SMC, order blocks are a key focus, representing areas where smart money has placed significant orders. In ICT, the focus is more on liquidity pools, where retail traders' orders are targeted by institutions. Risk management approaches. ICT traders often place a strong emphasis on risk management, using tight stops and careful position sizing. SMC traders may take a more flexible approach, allowing for wider stops to account for potential price fluctuations within a supply or demand zone. Deciding between ICT and SMC depends on your trading style, risk tolerance, and level of experience. Both approaches offer powerful insights into market dynamics, but they require a deep understanding of the concepts and a disciplined approach to trading. For beginners, if you're new to trading, starting with the basics of supply and demand and gradually incorporating elements from ICT or SMC can be a good approach. Focus on mastering the identification of key zones and understanding how price reacts to these areas. For advanced traders, if you're an experienced trader, you may find that combining elements from both ICT and SMC can enhance your trading strategy. For example, you might use ICT's focus on liquidity pools to identify potential trade setups, and then apply SMC's order blocks to refine your entry and exit points. Chapter 5. Practical Applications of Supply and Demand in ICT and SMC. Identifying high-probability supply and demand zones. To effectively trade using supply and demand, it's crucial to identify high-probability zones where price is likely to react. This involves analyzing historical price action, looking for areas where the price has previously reversed with strong momentum. One way to identify significant supply and demand zones is through volume analysis. High volume at a particular price level can indicate strong institutional interest, making it a potential supply or demand zone. Timeframes. The choice of timeframe is also important. Higher timeframes, such as the daily or weekly charts, tend to provide more reliable supply and demand zones. However, lower timeframes can be used for refining entries and exits. Supply and demand zones are particularly effective in trending markets, where price tends to move from one zone to another in a clear direction. In a trending market, traders can use supply and demand zones to enter trades in the direction of the trend. For example, in an uptrend, traders can look for demand zones to buy, anticipating a continuation of the trend. Supply and demand zones can also be used to trade pullbacks or retracements within a trend. By entering at a demand zone during a pullback in an uptrend, traders can capitalize on the next leg of the trend. Trading supply and demand in ranging markets. In ranging markets, supply and demand zones can be used to trade the range, buying at demand zones and selling at supply zones. Range boundaries. Identifying the boundaries of the range is crucial for trading in a ranging market. These boundaries are often defined by supply and demand zones, which act as the upper and lower limits where price repeatedly reverses. Ranging markets can often experience false breakouts, where price temporarily moves outside the range before returning. Understanding supply and demand zones can help traders avoid being trapped by these false breakouts, as they provide clear levels where reversals are likely to occur. In a ranging market, traders can place buy orders at demand zones and sell orders at supply zones. It's also common to use tight stops just outside these zones to minimize risk. Exits are usually placed at the opposite boundary of the range. This is the first part of supply and demand. Subscribe and turn on notifications so that you don't miss our second part. For now, watch this video and learn 3 key trading tools you need in your strategy. This will remove the doubts you have when placing trades. Happy trading!